All right, we are live. So I'm Robert Rogers, and today we are going over, I'm your neighborhood realtor. We're going over, this is our monthly webinar. So we're talking about why you may be feeling stuck in your home right now due to high interest rates. You know, when you're listening to the news media and everything, they love to make you believe that the real estate market is terrible right now and that you may not want to do anything right now, because that's the news media's job is to sell ads. So if all they did was preach good news every single day, that everything was awesome, then you wouldn't believe or you would not tune in and they wouldn't sell any ads. So therefore, that's why they constantly preach doom and gloom all the time. No matter what is going on in the world with everything, it's always doom and gloom. And so, that's why you got to come to somebody like me, your neighborhood realtor, to kind of tell you what's going on. So tonight, I'm going to go over 3 different ways that you're really not stuck in today's market, ways that I've helped current clients. And, so I'm going to share some of those stories with you so that you don't have to feel stuck and you can decide what options are going to be right for you. So one of the first things is that, we may never see interest rates around 3% again. That just is, that's, if you look back over time, the Fed has been tracking interest rates since 1941. And when you look over time, they were in the 15s and the 80s. People got used to that. It was difficult. And, we had this very, very brief moment in time where we saw interest rates around 3%. We may never, ever see those again. So, really what you have to do is make decisions that are going to be right for your financial situation, for your family, and be ultimately in the home that you want to be in, where you're going to make memories, where you're going to raise your kids. At the end of the day, that's what's important. And most Americans have a large part of their financial net worth tied up in their home. So you want to also make sure that it's a good investment. At the same time, you probably want to enjoy living there. So let's go over these 3 scenarios that some of them might, somewhat apply to you and why you're not stuck. So the first one is, home prices have increased a lot over the past few years. So you may have a lot more equity than you think. Unfortunately, a lot of these sites like Zillow and Zestimates, et cetera, they don't necessarily, it's an algorithm. They're not necessarily giving you a true picture of what your home may be worth, what upgrades you might have made, et cetera. So we would love the opportunity to, if you want to know truly what your home is worth, we would be happy to meet with you and give you a professional market analysis on what your house is worth, because you may have a lot more equity than you think. And, we can use this equity in different ways. So let me do some simple math here. Let's say you have a house that currently today is worth $400,000. Let's assume you paid $250,000 for it, and you currently owe about $220,000 on it. The house that you want to buy for your family is worth $600,000. So at your current, and that's the house that's going to meet your family's needs. It's got a bigger yard, more space. Your kids aren't having to share bedrooms, et cetera. So, hold on to that thought as well. But your current interest rate on your current home is around 3 3/4. So your payment is roughly about $1,600, $1,650 a month. Your approximate equity, though, is around $150,000. So option number 1 is you do what most people would do, and why most people think they have no options is because they think, well, I'll sell this house, I'll take my $150,000 equity, and I'll put it down on the new house. Well, let's just assume you're at a rate of 6 3/4 on the new house. That's going to put your payment around $3,650 a month. That's a $2,000 per month difference. That is a big jump for most families. That is a lot to swallow. So let's look at another scenario that might work for you. And that's that you go ahead, you sell your current home, you take your $150,000 equity, you buy your new house at $600,000, but instead of putting all of your equity down, you put only 10%. There are ways that you can do that and avoid private mortgage insurance. Now, that's going to kick your payment up a little bit. It's going to be more in the $4,200 a month range. I know that's getting even scarier. Kind of hear my logic here. You put $50,000 of your 150 equity in a high interest savings account. That is going to cover roughly, I had to do some quick math because I didn't leave that in my notes, a little over 2 years of that higher payment that you have. So, you were used to kind of 1650. You knew your payment's going to go up a little bit, but it's jumped way up to 4250. Well, but you have this $50,000 cushion there. You still have another 100,000 in equity, but you have this 50 there that you are using to offset any month when you can't make that 4250 payment. You just pull a little bit from that savings account. It's not there for anything else. It's not there for vacations, fun, new car, whatever. It is strictly there to make easing into this new payment easier. Then you put the remaining 40,000 that you have left over. So you used 60 put down, then you put 50 of what you had left over in a savings account. Then you invest the other 40,000 into a brokerage account. Get with a financial planner. If you need some recommendations, I can help you out there. And now through both of these, high yield savings accounts right now are getting in the high 4s. Then your brokerage account is ideally going to earn 8% or more. So you're also kind of offsetting that higher interest rate as well. We all know rates go up, rates go down. At some point in time in the next few years, they keep saying rates are going to, come down next year. We've kind of seen them start to trend down. You're going to refinance that mortgage when rates fall. Let's say that you're able to refinance at a little over 5% when rates fall. You find that perfect time period, you're in the house that's right for your family and you refinance. Now you're going to have a payment, in the mid 3s range. Still, a fair amount higher. However, this, utilizing the previous equity from your old house, you've kind of helped yourself grow into that. Give yourself some time to get used to that payment. In the meantime, you're in the house that your family needs to be in a house that's going to appreciate quicker than your old house. Because if you just wait on that one to keep appreciating, you're always going to be in the rat race where it's never going to appreciate enough to then suddenly make the jump into this more expensive house that's also going to keep appreciating, but probably at a faster rate. Now, this is kind of an extreme example. There are some other options you could do here to maybe, jump to only a $500,000 house instead of a $600,000 house. Maybe you move a little further out. You might be able to get a larger, nicer home, for less than $600,000. Another thing to think about, maybe you move, down to like Moyock, North Carolina, where you just get just over the North Carolina line. Your property taxes are probably going to be about half of what they're going to be in most parts of Hampton Roads. That is, again, another savings on your monthly payment, just another way to kind of help that payment differential not be so big and you still get kind of the house that you need. Another thing that you maybe could do is buy a house that is the size you need, but maybe it needs some work and it's not a lot more expensive than the house that you're currently in. You use some of this equity to fix it up because the payment isn't as extreme as, you know, the payment jump would be if you go straight from 400 to 600. So that's my, you know, kind of scenario number one that might work for you. Scenario number two would be that maybe we can strategize to use your equity to reduce some of your other debt and keep your debt structure similar or the same to where you are currently. I'll give you an example. I just sold a house to some people. They actually needed to buy their new home before selling their old one because a house came on the market that they just absolutely had to have. It was across the street from a family member. They wanted to be in that house. So we went ahead, you know, bought the house. They were able to get into it using a VA loan, so they didn't have to put any money down. The house actually needed some work, so they got all of their closing costs paid. They didn't have to come out of pocket any money to buy this house. Now, they're currently in a townhouse that they're used to around the $1,600-ish a month payment on. They bought it several years ago, actually about 5 or 6 years ago. They have a lot of equity in it. However, this is still a big payment jump. Their payment jumped almost double what they were used to. So that was a big jump. What we did, though, was we sat down and we strategized, because this is much more of a holistic approach. So what we did is we kind of looked at, now they don't have, you know, crazy expensive cars or anything like that. They both did have newer vehicles that did have debt on them. In the process of doing all this, as we sell their old house, we're going to pay off both of those cars. They're still going to have a ton of equity left over. From that, you know, so they've gone ahead, they bought the new house, they fixed it up, you know, did what they needed to do to, you know, they had to use some of their savings to fix the house up because it wasn't really in move-in condition. So they did kind of the bare minimum to get it move in where they could move in. Now they're sitting with this $3,200 roughly a month payment, you know, which is it's double from where they were before. Everyone, though, does expect that when they trade up to a bigger house, their payment's going to go up. I mean, it's just the way, you know, math always works that way. However, again, double's pretty big. What they did was, so again, they got in there, then we turned around, we sold their old place. They have about $120,000 equity in that place. So we're paying off, you know, a couple cars, which the total debt on was about $900 a month between both payments. So you can kind of do the math and see we're paying 1,600-ish plus 900, that's about 2,500. Before is what they were used to. Well, now we're at 3,200. But what we did was, because we knocked out that 900, the jump is only about $700 a month, which is about what anybody would expect when they trade up from a house that's, you know, almost double the size of the one they were in before, you know, only going up in terms of your debt structure and your total monthly outlay. It's about $700 a month. They're taking all the rest of that equity that they have left over and investing it. You know, they're going to replenish a little bit of their savings that they had to spend to get the other house ready, but they're going to go ahead and, you know, just put that in an investment account with their financial planner and let it grow. They're going to be, the house they bought too, they bought under market value because of its condition. So they're increasing their equity there. So in terms of a long-term play, they are financially way better off at only $700 more per month than they were prior to making these two moves. In addition, they actually have enough left over. If they wanted to, they could actually buy an investment property that would probably cash flow $300 or $400 a month and further amplify their net worth. So that's another option as well. Now, one of the things to think about is if we had kept that old house, because this was another option in this whole scenario we looked at, was keeping it. and them keep it as a rental, they would have cash flowed pretty well on it, but not near as good as having that equity to put in all these different moving parts. So that's where I think it is really important that, you have somebody in your corner like me or a member of my team that's going to really sit down with you and look at this as a holistic approach, because we really have to look at everything. It's not just as simple as going out there and looking at houses, because, that may not be the best situation. I mean, we might sit down, we might do all this and decide that now really isn't the right time for you to move. And that's where it really takes this holistic approach. So then my third reason here that you may not be stuck is another option that another one of my clients did last year, actually. And we maybe have to rent your current home out for cash flow, which would then offset your payment on the new house. So back in, it was either 2018 or 2019, I sold this cute little house in Norfolk to this couple. It was around $220,000. It's now worth in the low 300s. They decided to keep it as a rental. This was a long-term play for them because they knew that one day renters would pay this house off, and then they would be able to sell the house, and that would be their kids' college fund. So it made way more sense to keep this house than it did to sell it. Their payment on this house was just over $1,000 a month. I think it was like $1,100 a month. They were able to rent this house for $2,200 a month, effectively double their payment. They manage it themselves. They only have one property, so they don't think that it's, a pain to manage it themselves. So they are able to keep that full cash flow of $1,100 a month. So when they went and bought their new house for $400,000, they did have some payment shock. Their new payment was about $3,000 a month. However, they are offsetting that payment to about $1,900 or $2,000 a month because of that rent, the income that they're collecting off the other property. Then they're in a great position as well, because when rates fall, they'll refinance. Their payment will only be about, call it $2,500-ish a month. Then they'll be in a really good financial position. And the house that they bought for $400 is already up to around $440, $450. And because they're about to have another kid, they're actually already thinking about selling that house and trading up again. One of the things to think about is real estate traditionally keeps going up. There's only been one time in history when we've had consecutive years where real estate went down, and that was around 2008. Most of the time, it always trends up. Some years may flatline, some years may take a tiny dip, but the majority of the time, it just keeps going up. And in the world we live in today, real estate, like everything else, is only going to continually get more expensive, as unfortunately, the value of a dollar gets less. So holding on to real estate is going to be best for your long-term wealth. One of the other things I say is that this also really takes all of us sitting down. And sometimes we need to, I've sat with people and we've called their financial planner into the mix, their accountant into the mix. I just helped somebody the past couple years sell an investment property, and then they're going to turn around and buy another one because they had this property for so long that their accountant told them, that this was a good year. Their income was down that year, and so they could afford to sell that property that year. And, their tax burden would be about the same that they were used to on years when their income was higher. So she encouraged them to go ahead and sell it, buy another property that then they could redepreciate for tax benefits. So there's all kinds of strategy here. And that's where I say, it's super important that, if we need to call in other professionals, that's what we're here to do. And if any of you have any questions, drop them in the chat, and happy to answer them. We're going to do these continually every single month on different topics. So anything you have, feel free, if you're watching the replay of this, feel free to either shoot me an email or shoot a message on whatever platform you're watching the replay on. We're happy to answer those questions. And next month, our topic is going to be basically how to get out of your rental. So if you are, a first-time buyer, or you've been renting and you really want to kick off 2024, you're tired of renting, tired of being a slave to a landlord, we can help you do that. And we're going to go through a whole video series on how you can do that. So make sure you tune in Monday, January 22nd, 7 p.m. Make sure you get registered for that. And as always, I'm Robert Rogers. I'm your neighborhood realtor. And tonight we're signing off.